The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Happy Friday, everyone, and welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick, and these are your headlines. Elevated yields rattle global markets, with the 10-year Treasury yield holding near an 8-month high, while the UK Treasury seeks to reinsure investors amid rising pressure.
UK gilt markets continue to function in an orderly way. Underlying demand for the UK's debt remains strong, with a generally well-diversified investor base.
Chinese yields rise as we see the yuan hitting a 16-month low as the country's central bank suspends treasury buying, citing a shortage of bonds available in the market.
Elon Musk repeats his support for Germany's far-right AfD in a conversation with the party's leader Alice Weidel on X, once again raising concerns about the world's richest man meddling in European politics.
As I've said publicly, I think only AfD can save Germany. And I just want to be very clear about that. Only AfD can save Germany. End of story.
French plane maker Airbus delivers 766 jets in 2024, just missing expectations but maintaining its lead over rival Boeing for a 6th year.
And US futures point lower after the market holiday, with all eyes now on December's non-farm payrolls report that is due out later today. Well, let's take a look at some of the market action for Friday. It's certainly been a roller coaster on bond markets, and that is rolling across to the equity markets. What we're seeing across in Asia, Japanese stocks are downbeat with 39,258, a drop of 0.9%. Hong Kong down to a similar extent, and the Chinese market shedding about 0.5%. The Kospi down slightly, but the Chinese market also interesting in this context as to whether the Chinese authorities are stepping in, trying to present some sort of a prop under the Chinese yield, which in contrast, of course, to other global markets, investors have been pushing lower over the course of the last number of weeks. So let's just take a look elsewhere at that 10-year global yield that we're seeing across the board on the States, the Treasury. We're 4.69% this morning. So we've escalated to an 8-month high. We're perched, as you can see, just off 4.7%. German bonds, we're 2.54%. So what is interesting is that some of the bonds on the continent have escaped some of the heat that you're seeing elsewhere, but they are just slowly being dragged higher, not to the same extent. The Japanese JGB were 1.19%. We've had a rise there, and it is the gilt here in the UK we're watching closely from the 10-year to 30-year. The 10-year now the highest level since 2008. So it is causing some consternation around circles in the UK, from business circles to the central bank and, of course, over to Parliament as to what we're dealing with here. Is it a reaction to the UK and fiscal policy? Is it purely that we're being dragged along with global markets? It is something we'll be talking a lot about. I want to take you to treasuries in particular. The next stop, no doubt, is the non-farm payrolls later on today. If we get a hot report, a mediocre report, a soft report, what will that do to the bond markets that are now anxious about inflation and whether Trump-era policies again could stir further inflation pressure? So 4.27% is what we've got at the 2-year, the 10-year 4.69%. So right across the curve, we are marching into the green, Steve.
Good morning, Karen. How are you?
Very well, thank you. You?
Good. I am super. There's something wonderfully delicious about the news flow around the moment. And I'll get to the next story in a moment. But you've got China with deflation and stagflation concerns and a bond yield that is plummeting. You've got the United Kingdom with inflation and fiscal concerns with a bond yield that is surging. Isn't it delicious that Rachel Reeves is in China?
There is that point.
I find that quite extraordinary.
The delicious point for me is that there's been so much noise, and there's no doubt there's a lot of political leaders and commentators that are filling up the airwaves. But what you've got at the market is a reaction to fundamentals, where we've had so much excess in government spending in recent years, concerns about what that will look like down the track, and you've got a fundamental reaction taking place to what we're looking at in terms of the pathway on spending and rates.
But why now? Because these dangers have been clear and present.
Issuance, isn't it? It's the issuance ahead for this year.
May I disagree? We've known about this for a very long time. We've known about it since her budget. We've known about the problem since the Tories were in power. We've known about a lot of these issues, about deficits in the United States, about stagflation concerns in China, about the European fiscal position. There is nothing new in any of this.
Shall I hold your hand and take you back over the calendar of last year? Because we know markets can only react to one event at a time. And, you know, the back end of last year was filled up with Trump trades going into the election, after the election. You had Chinese stimulus, the market hoping that it would catch some sort of a bid. But I think you've had a market reacting to slow moving pieces. This big overarching story around yields, they haven't had a chance to react to necessarily because there was so much short-term dynamic trading. Now you've got this big picture around issuance. It's here, we're on the cusp of it, and you are seeing the reaction.
Saying that the market treats news as a pick and mix, for our American audience, as a candy trough, because I think you are. I think you're saying they don't look at the whole panoply of confectionery in front of them, but they pick which sweetie they like at the time. And actually, they like oh no, that's like a nutty one. I don't like that one. So basically, they're ignoring all the horrible taste while they're just picking out the lovely sweet candy. And every now and again, they pick a nasty one. And think, oh God, that's just, I can't get rid of that taste in my mouth.
Well, we've been sitting around the same set, and the last 10 years has morphed a lot, where long-term investors used to make long-term trades on fundamental ideas like this, but something called dynamic trading got in the way. We've seen enormous swings in performance in quarterly, weekly, monthly basis. So I think you've now got investors trading the short-term news flow, and the tech story has been a great example of that around AI.
I disagree with you.
I think the long-term themes are there, but there's been some dynamic trading in the way that is genuinely moving the market more.
I don't disagree that there are traders, but I don't believe that the investors are doing that. Why don't we ask
dynamic trading? We've heard it from them.
From investors, from long-term pension fund holders,
we've heard it from
dynamic trading.
long-term investors that they're dynamic investing these days.
I find that hard to believe. UK Chancellor Rachel Reeves is facing mounting pressure amid an ongoing rise in borrowing costs, with the yield on the 10-year gilt rising to its highest level since the financial crisis. Sterling also seeing continued pressure amid the bond market turmoil, falling to a 14-month low against the US dollar. So Rachel Reeves resisted calls to cancel her trip to China amid the economic unrest. But she must have been in Parliament to explain what was... No, she wasn't. She sent her deputy, Darren Jones, to address Parliament after an urgent question was allowed by Lindsay Hoyle, the Speaker. In Parliament, let's listen in to Darren Jones.
It is normal for the price and yields of gilts to vary when there are wider movements in global financial markets, including in response to economic data. In recent months, moves in financial markets have been largely driven by data and global geopolitical events, which is to be expected as markets adjust to new information. UK gilt markets continue to function in an orderly way. Underlying demand for the UK's debt remains strong, with a generally well-diverse investor base.
I would almost... Sorry, I've got to come back. Darren Jones there, pretty much saying what we're saying, that it's relying on a new incoming data. But it would almost be better for Darren Jones and the Chancellor and the government if actually he was saying, no, this is just irrational stuff going on at the moment. But what he's saying, I think he's saying there, is that actually, yeah, you're right, market. but that's damning for the government then, because if it was irrational, then he could turn around and say, well, I think it's irrational moves in the market. I don't agree with the moves. But what he's saying is the market is acting in an orderly fashion to the new incoming data. Well, that means the market is selling off for very, very good reason on the Labour economic plan, from what he's saying, I think.
Well, so what does the government do at this point? And we were discussing that at length yesterday. I mean, at this point, do they try and ride it out, given it's a global story that's been unfolding? Or do you see it as some sort of targeted approach? And, the issue on tax and spending Is there any more room in the economy for more tax? I mean, we've been talking about how businesses, we saw it yesterday from the retail sector, how they're reeling from the level of taxation and that the higher contributions they're having to pay. So is the spending side in doubt?
And there's another little story, I've got to say it very quickly. Did you see that Liz Truss's lawyers have got in touch with Sir Keir Starmer? Cease and desist saying that I crashed the economy. So says Liz Truss. OK, let's move on. We'll continue our coverage of the UK bond market turmoil with the former Secretary of State for Business, Energy and Industrial Strategy. That's Sir Vince Cable, isn't it? That conversation later on this hour. China's central bank has suspended Treasury bond buying, pushing yields higher. The PBOC cited a shortage of bonds in the market as the reason behind the move. Samantha joins us with more. How lovely to see you today. Are you excited about the Reeves visit to China? I'm not sure the Chinese will have time to speak to her, will they?
Well, it's interesting that you say that, Steve, because you were talking about delicious. It looks like the British media is licking their lips over this story a lot more than the Chinese media, because there's not really been a huge amount that's been sort of publicised over on the mainland regarding this trip. So what does that say? Well, I'll be sending you a report later in the program with a bit of an update on that. But back to the bond yields, a fascinating story. We started the day with the PBOC commentary, as you mentioned, saying that it's going to temporarily suspend its bond purchasing activities. And this just comes a few months after it said that it would be buying and selling bonds in the secondary market. So is this a surprise or not a surprise? Some say it is, some say it isn't, particularly because the moves that we've seen in the CGBs has been fast and furious. If you look at December, 50 basis points across the board. And so the PBOC is no doubt very nervous about what that means with the widening yield differential between the US and China, pressure on capital outflows, and of course the Chinese currency. And so what they've said is that this is because of supply of these bonds, not enough. Now, some don't subscribe to that view. They don't believe that this is down to supply. They believe that there is sufficient amount given the continued issuance of these government bonds. And this is really down to just basically market forces. They don't believe that the effect of what the PBOC is doing here, while it has helped the yields jump up ever so slightly today, that the effect is going to be sort of temporary. And that is because you've seen a lot of appetite for these bonds from the banks, the institutional investors, because quite frankly, the default risk is limited. And also, as our colleague Annie Iqbal has actually spelt out in her article on CNBC.com, which I implore you to go and read, is that these banks are caught in a bit of a rock and a hard place because the loan demand is not there. So, I mean, they've got nowhere else to invest, and that's why they've been going to the bond market. It also very much speaks to the disinflationary pressures that China has been facing. Of course, we got more evidence of that yesterday, and very much the economic uncertainties right now. So the PBOC has sort of been signalling to the market that it is uncomfortable with these falling yields. There has been some expectation that we could have seen the 10-year going to about 1.2%, according to the folks over at HSBC. Some have been suggesting that in 2025 we could see sub 1%, unless the economy responds. But there's also been some reporting in recent weeks around the PBOC also having a bit of a word to some of these banks and fund managers about their bond activities. So that's what the PBOC has been up to, as I said, to also try to defend the yuan. That's been sort of the thinking here and the view because of the depreciation pressure we've seen on the currency. We certainly have seen the PBOC's yuan midpoint fixing each morning on the firmer side of 7.2, which continues to be interpreted by the market as its way to sort of create a bit of a buffer here. But remembering, as I've been mentioning, I think I spoke about this yesterday, that many have been also comparing what we're seeing in the CGBs to the JGBs too. On the longer end, it has actually gone past below the JGBs on the 30-year, and there had been some expectation that we could be pushing that on the 10-year as well in time. So No doubt that caught the attention of the PBOC as to why we've seen this movement and this commentary out today, guys.
Sam, thank you very much for that. And for plenty more on what Sam was mentioning there in the article, mentioned challenges facing Chinese authorities, you can check out CNBC.com. Investors are watching out for today's jobs report, which is widely expected to show a mixed view of the US labour market. December non-farm payrolls are expected to rise by 155,000, weaker than the November print of 227,000, but keeping within the 4-month average. Meanwhile, the unemployment rate is largely expected to hold steady at 4.2%. Let's get to John Sylvia, founder and CEO at Dynamic Economic Strategy, former chief economist at Wells Fargo. John, great to have you back on the channel. I just mentioned some of the forecasts there for the non-farm payrolls, but I've got to say I'm seeing some very wide expectations out there in the marketplace. 120k to 200k on the headline figure, the unemployment rate 4.1 to 4.4%. It feels like the market doesn't really know what it's setting up for. What do you make of that?
Yeah, I think, first of all, I really enjoyed your discussion on the fundamentals and bond yields. I think that was a good summary of what's going on. In part, I'm estimating 170,000 in terms of job gains, and there are some reasons behind it. The NFIB Small Business Survey talked about increased hiring. The Consumer Confidence Survey from the Conference Board talked about net jobs available improved, and jobless claims continue to stay remarkably low. And I think in part what you're seeing is the markets are reacting to the news, as you mentioned earlier, that is stronger than what they expected. So the commentary about why the bond market has moved off so much in terms of rising yields, it's because they expected Fed easing in 2025, and that expectation has been diminished. They expected slower inflation. That also has diminished in terms of probability. And so what you're seeing here is a strong job market that gives you 2% plus economic growth and doesn't provide a good case for the Fed to ease, certainly not in January, and probably not in March as well. So when you're talking about your fundamentals, which I really enjoyed as an economist, you're seeing a stronger job market than what the market what the financial market had expected at the start of the year.
John, the market assessing some of those macroeconomic dynamics often says, well, stronger economy, that is great news for corporate profitability. It is great news giving us some cover to buy US stocks. But in the last number of sessions, it feels as though that good news has now gone to bad news. If we look at the bond market reaction, and it was a great piece yesterday, I think it was the Wall Street Journal, talking about whether we're now at the point where any stronger economic scenario is in fact bad news because it just brings more inflation, but no more economic benefit.
Yeah, it's fascinating, and you're right on point. Sometimes when we see the market dynamics, information that was taken as positive now becomes a negative. And you're quite, in my world anyway, I'm seeing that the economic growth is just too strong for the Fed to ease. The inflationary pressures continue to move forward. We saw that with, for example, the ISM services numbers, the ISM manufacturing prices paid numbers. So yes, at some point, the good news continues in terms of the economy, but it's not good news for the market when the market expects Fed easing, they expect lower inflation, and they're not getting it.
John, lovely to see you, and thank goodness you're awake at 1:18 in the morning to chat to us. We are loving your conversation, sir. But I've been around in the market, it's not as long as you, but a while. I mean, 38 years I've been looking at, 37 years I've been looking at payroll figures, and I've been excited most payroll months. But I'm less excited now, and I think the Fed is less excited now, and I think the market is less excited now because we all know that the tsunami that is Donald Trump is coming in 10 days. And quite frankly, any data watching at historic jobs numbers is, I'm loath to say it, but it's almost irrelevant to the tsunami of policy and protestation that's going to come out of the White House as well. That's where we're all looking now, isn't it, John?
Oh, absolutely. I think the economy is providing a good base for what we expect going forward, but the policy is going to be incredibly significant. I think you folks have talked before about the immigration issue in the United States. Well, a lot of those immigrants are actually working. And so the question is, to what extent these immigrants going to be sent back home, and to what extent that impacts the labor market? We've talked about tariffs, and generally, as we know, tariffs, at least in the short run, do raise prices. Well, that's going to be difficult for the Federal Reserve, because when they measure the inflation rate, at least in the short run, that means those inflation numbers are going to be higher. Deregulation is a little bit tricky in terms of trying to measure it. And then finally, are we going to cut taxes or not? Well, I got an economy that's growing, let's say 2.5%. It looks pretty good. Consumers are spending money, businesses investing, and I'm going to add a tax cut as a stimulus to demand in the economy, given, as you mentioned, the constraint of 4.2% unemployment, which again is fairly low, but it is pretty consistent with what the Fed looks at full employment. I'm looking at all those policy changes. They're all coming at me. It creates a high level of uncertainty going forward.
And John, look, thankfully, bond defaults and bond delinquencies, they remain fairly low across the board. But if money is going to be a higher cost for longer and the Fed is going to remain higher for longer, are we ignoring at the moment in bond world and in corporate credit world the ramifications of higher for longer in terms of bonds as a result of policy, as a result of the fact that the economy is relatively robust? Have we got a banana skin coming?
Well, if you get beyond page 1 and you look at page 2, what you're seeing is there are credit issues with respect to refinancing some of the less expensive debt that was sold 3 to 5 years ago. We are looking at challenges on terms of consumer credit cards and auto loans in terms of delinquencies. So it's not on page 1, but it is on page 2. You see that creeping problem with respect to corporate defaults, companies shutting down, particularly in the United States, some of the bigger consumer numbers, consumer names being shut down. So yeah, it's on page 2. It's there. It's not in the headlines right now because so much, as you said, is focused on the new administration and what they're going to do on day one. But on page 2, you can see the credit numbers being squeezed in terms of the quality of credit in the United States.
John, just quickly before we let you go, I want to ask you about the impact of the wildfires. We're still watching this devastation, and so far the tally is at more than $50 billion in costs. But we know that natural disasters can have an economic consequence when rebuilding takes place, and it can skew the economy. What is your early assessment of the impact?
Well, the impact, of course, first shows up in terms of the lost wealth. In the short run, there is some rebuilding of properties with respect to both the hurricanes and the fires. But longer term, the problem is the insurance costs go up. And as we know, in many states in the United States, the insurance costs have risen pretty significantly to cover these disasters. And so the challenge is that housing becomes more expensive, not because simply building the house or maintaining the house, but also the insurance costs that go along with that. That hits consumer incomes and reduces consumers' ability to spend in other areas. So that is, for the American economy, pretty significant in terms of the longer run impact of some of these fires and hurricanes.
John, we've just been running pictures while you're talking of the unbelievably skillful and brave helicopter firefighters as well, to all the firefighters in LA and around the world at the moment. Well, I take my hat off to you. You are brave and stunningly skilled. John, lovely to see you. We really enjoyed the interview. If ever you're on this side of Atlantic as well, we'll get you around the desk for a long chat as well. But in the meantime, thank you, sir. Have a great day. John Sylvia, who is founder and CEO of Dynamic Economic Strategy and former chief economist, of course, at Wells. Right, our US colleagues will be speaking to the Chicago Fed President, Austin Goolsbee, later today. Tune into that conversation at 1600 Central European Time.
Plenty coming up on the show. We're only about 20 odd minutes in. We're going to break down the numbers of Airbus after deliveries come in just shy of the plane maker's targets for the year. Plus, Elon Musk continues his support for Germany's far-right AfD party, hosting a live stream with their candidate for Chancellor on X. We'll have details of that conversation. And we'll continue our coverage of the UK bond market turmoil with the country's former Secretary of State for Business, Vince Cable. That conversation later this hour. Airbus delivered 766 planes last year, just shy of its annual target of around 770, and more than the 735 it delivered back in 2023. The company is widely expected to retain its title as the world's largest plane maker by deliveries for the 6th year in a row. Well, Charlotte joins us with more. Charlotte, spent a lot of time in the air in the last couple of weeks. I've got to say, it does make a difference what plane you're on. So a lot of invested interest in this segment.
Yeah, and those new planes are so quiet as well. And we see a lot of airlines actually want these new planes, more fuel efficient. And that's why that for Airbus, they have the clients, they have the customers. A lot of these airlines want their new planes. The problem for them is getting them out fast enough. Again, the backlog, they have 8,600 planes in backlog, so more than 10 years of production ahead of them. But getting those planes out fast enough is a challenge for them. So 766 deliveries. Christian Scherer, the CEO of commercial aircraft for Airbus, saying yesterday, so far, so quite good. So they almost reached the guidance that they given of 770 planes for the year. They had a previous target, remember, at the beginning of the year of 800 planes. They had to downgrade that in the middle of the year because they said the supply chain was still challenging. And that's, again, what they're working with. We know they had some problems with engines, but other pieces as well, because they're working with literally hundreds of suppliers. And so they're trying to bring up the whole supply chain with them to try to ramp up production. So that's a challenge. We're still very far from the numbers that we had before the pandemic. In 2019, they delivered a record 860. So we're still very far from these numbers. But again, they're working to improve this. And they said yesterday, to reassure investors, that they are on track in the production ramp-up of the A320. Again, they gave a guidance, a target of 75 planes per month produced by 2026, and they say they are on track to meet that target. So they are happy. They address some of the key issues that they had in their supply chain, but here again, they have the difficulties with the suppliers, and some of the suppliers, of course, that work with Boeing, and that's the issue that they have. Is the whole ecosystem that has been a little bit fragile because of the issues at Boeing there. So Airbus is working with them again, and again giving this reassuring note that they are on track for the production ramp-up.
Beluga, the cutest looking plane of all time. Let us move on. Thank you very much indeed for that. And I did have to say, when you two were talking about the quietness of your journeys, you obviously weren't next to the young family that I was on the last time I flew. Let's move on. Thank you very much.
Thank you for listening to Squawk Box Europe Express.
For more market moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.